But I do think there are alternatives. I do think that gold is still underowned. I'm bullish on Bitcoin. We talked about that.
Yeah.
Um, I think that a number of emerging markets are attractive when sized appropriately. And I've somewhat counterintuitively been pretty bullish on U.S. financials, especially on a total return basis, like when you include just kind of reinvested dividends along that kind of 10-year time horizon. For Bitcoin, depending on what time period you're looking at, I mean, their nominal returns have been so strong that even like the Sharpe ratio is still very high in most cases in most time frames. So even on a risk adjusted basis, Bitcoin still has really strong performance. And with Bitcoin, at least over the past 5 years, 10 years, you've gotten way higher returns, way higher volatility. So even risk adjusted is still great. It's just that you have to just be cautious of that.
Lynn Alden remains highly confident in Bitcoin's long-term potential. Despite its notorious volatility, she emphasizes that Bitcoin's risk-adjusted returns, including its Sharpe ratios, remain strong across nearly all significant timeframes. Even when accounting for market drawdowns, she explains, Bitcoin continues to outperform traditional assets on a risk-adjusted basis. Alden shares her personal investment framework, suggesting that instead of the traditional 60-40 portfolio, investors could replace a portion of bonds with gold and allocate part of their equity exposure to Bitcoin. Remember to click the subscribe button and enable notifications to ensure that you never miss our most recent analysis. Thank you and enjoy the video.
Right. So for the first question, I think gold's attractive in multiple ways. I do like physical where possible, up to
Yeah.
someone's kind of security threshold. That's one of the benefits is holding a scarce fungible asset in your own custody. So that's
Yeah.
one of the advantages. Once you run in kind of a where security becomes worth thinking about, then you want to generally find non-rehypothecated, non-bank holding
Yeah.
of it, and people, depending on what jurisdiction you're in, that there's multiple options there. You can spread them out. There are even gold-backed stablecoins if one wants some degree of international portability with that. And so all that's interesting. For Bitcoin, depending on what time period you're looking at, I mean, their nominal returns have been so strong that even like the Sharpe ratio is still very high in most cases in most time frames. So even on a risk adjusted basis, Bitcoin still has really strong performance. Now, obviously, if you wouldn't want your whole portfolio fluctuating to that extreme degree, you'd have to position size it. But the way that I've generally positioned it is, when I say, okay, we'll start with a 60-40 portfolio, how can we improve that given the fiscal dominance that I've been forecasting and other things like that? Well, one was replace a slice of your bonds with gold. I think gold's better than bonds in this environment. And then consider replacing a slice of your equities with Bitcoin, because you're kind of comparing a similar, high volatility asset with a high volatility asset and a lower volatility asset with a lower volatility asset. And that's why I've been thinking about it. So they do have different volatility profiles. And with Bitcoin, at least, over the past 5 years, 10 years, you've gotten way higher returns, way higher volatility. So even risk adjusted is still great. It's just that you have to just be cautious of that. Yeah, I'm in that camp. I think they can still be positive, but it's probably not great. Not as good to say the 2010s decade. But I do think there are alternatives. I do think that gold is still underowned. I'm bullish on Bitcoin. We talked about that.
Yeah.
I think that a number of emerging markets are attractive when sized appropriately. And I've somewhat counterintuitively been pretty bullish on U.S. financials, especially on a total return basis, like when you include just kind of reinvested dividends along that kind of 10-year time horizon. Because I think unless I see signs that the financial repression is directed at the banks, I think they're going to be pass-through entities, and they're going to benefit from a rising monetary base, cheap existing valuations, kind of heavy doses of dividends and buybacks along the way. So I think there are certain sectors you can buy. I think there's certain geographies you can buy, as well as some of these other, non-security assets. Those were like the nickels on the side of this whole thing. That's like the other 15% of the pie chart, and they're kind of swimming in there and trimming a couple things, while all these big parts of the pie chart is completely, it's a third rail to cut them. And then also, the GOP is not going to, other than maybe tariffs, apparently, they're not going to meaningfully raise taxes. If anything, they want to cut them and keep them low. So my base case was they're going to extend the tax cuts. And so you can get a slightly different flavor of the deficit depending on who wins, but a lot of it's locked in. And then we have the added problem that because the US is so financialized, there's so much global capital stuffed into US equity markets, and because we have pretty high wealth concentration, and because we have a lot of equity-based compensation, um, we have a correlation problem, which is that if you did somehow, in a miracle, do some degree of austerity and, like, say, cut the deficit in half, we probably would have a period of slower economic growth and bad asset prices from the hangover of that. And then with say, a 12-month lag, if you get flat to down like stock market, usually the tax receipts start to suffer because of that, because we're more financialized than most other countries. And so even then, you actually still have trouble getting the deficit down. So it's like the number of things that has to go right to invalidate my thesis that we're going to run deficits big for the next 5, 10 plus years is so improbable. So I monitor it. But yeah, my base case is just structural deficits, regardless of political changes. So 6 months, I don't know, because it's very headline driven.
Sure.
It's still fully not clear what's going to happen with tariffs. It's not clear what's going to happen with a bunch of things. I generally view U.S. equities, like the large indices at least, as probably in a grinding sideways pattern for a number of years. Now that could be slightly grinding up. That could be punctuated by 20% drawdowns and such. But much like the 70s, they didn't really go anywhere. Or that even in the 2000s, they weren't particularly strong performing compared to other asset classes. I just do think in general that from both demographics purposes, potentially international capital rotations, existing valuations as kind of like a starting point. I mentioned before the potential peak in margins, where they don't necessarily go down. They might, but they don't necessarily go down, but they might just go sideways now. So they no longer benefit from that. So I think when you take a bunch of tailwinds away, especially on an inflation-adjusted basis, I'm not very bullish on the multi-year outlook for American equity indices. I think there's a reasonable chance of international outperformance over the next, call it 3 to 5 years. I still think that the S&P 500 could fall relative to gold and certain other assets, without being, say, super bearish on it. Just because when you have such fiscal dominance, when you're running almost 7% of GDP deficits outside of a recession, that is kind of indirectly good for the stock market in some ways. So I think that the floor is somewhat held up, but I also think the ceiling is also kind of heavy.
Alden highlights how important liquidity is in today's markets. Since the US dollar is still the most widely used and accepted form of money globally, many assets depend heavily on how much dollar liquidity is available. This means that risk assets like Bitcoin, tech stocks, and even real estate often move in the same direction as overall liquidity flows. However, she also points out that there are situations where Bitcoin can perform better than equities, for example, if global liquidity is strong, but US companies are facing sector-specific challenges. Don't forget to subscribe and hit the bell icon to stay updated on our latest videos. We'd love to hear your thoughts in the comments. Now let's dive back into the interview.
I think that, especially ever since 2020, we've been in a macro-heavy environment where liquidity drives a lot of things.
Heck yeah.
And so a lot of things are correlated with liquidity, and therefore they're correlated with each other, especially risk on tech-focused assets. There are scenarios where Bitcoin can do well and NASDAQ would suffer. And that would be, for example, anything that is fine for liquidity, but bad for NASDAQ margins. So trade wars, stagflationary scenarios, certain things like that can impair or changes in tax policy or certain types of industrial policy from kind of a top-down perspective. Certain things can impair margins in a given jurisdiction, like in this case, the U.S., while global liquidity is still fine. And if anything, that's probably my base case is kind of, we've been in this kind of period of structurally rising corporate margins. And I think we're probably going to start hitting the ceiling of that. Doesn't mean we give that all up, but I think we maybe stop going up for starters. If we do get one of those kind of like globalization cycles, so some capital, instead of being stuffed into the US as it has been for the past 15 years, every once in a while you have these kind of cycles where some money comes out. So this happened in the 2003 to 2007 period. It happened again in another cycle before that. If we get one of those periods, I think you'd probably see Bitcoin do a lot better than the NASDAQ. What I do think they have in common is they both have heavily correlation with liquidity. And that's going to continue as long as, right now, the most saleable money globally by far is the dollar. That's what most global liabilities are denominated in. Obviously, within a country, they have other denominations for many liabilities, but certainly cross-border liabilities. And as long as that's the case, liquidity is kind of the name of the game for a lot of assets.
Right. Okay, but why Bitcoin above gold? What is appealing to you about that asset?
Two things. One is that gold has an issue where it's slow. A tangible example: Germany wanted to repatriate its gold in the 2010s. They initiated the process in 2013. I forget the number of years they budgeted, but it was in years that they planned to do it.
Right.
They were happy that they were able to do it within 3 years. At the cost of millions of dollars of repatriating their gold, all the physical transport, the logistics, the auditing. It's a cumbersome process. Whereas with Bitcoin, you can settle final value, so irreversible value, within the hour at any size. And so it's basically a way to run a ledger in a decentralized way with its own scarce units attached. It's basically kind of like a Fedwire and a gold combined together. So it's a settlement system with its own units. That's pretty interesting. And number two is just as it's small right now, it's growing into whatever its total addressable market is going to be. So if someone has a thesis that the capability is valuable and that it's the leading asset in that category, so it's a category that benefits from network effects, kind of protocol dominance, just like any other sort of communication protocol. You say, well, what's the total addressable market? Right now, out of total assets in the world, Bitcoin is something like 0.2% of total assets. Gold is something like 2%, about one order of magnitude bigger. I think both of those numbers are probably going to increase, but Bitcoin is increasing from a smaller base. And so I think Paul Tudor Jones, phrased it well, which is the fastest horse in the race. So between the two, in my holding period, Bitcoin's given much better returns. But it doesn't mean you have to only be exclusively in the potentially higher volatility, better returning asset.
Lynn Alden pointed out that because the U.S. economy is so financialized with a lot of wealth tied up in stocks and equity-based compensation, any attempt at austerity, like halving the deficit, would likely slow economic growth and hurt asset prices. This would reduce tax receipts later on, making it hard to sustain deficit cuts. In her view, there are simply too many things that would have to go perfectly for the U.S. to avoid running big deficits over the next 5 to 10 years. Regarding the market, Lynn believes that U.S. stocks will probably meander sideways for a few years. They may experience modest increases or sporadic 20% declines, resembling trends in the 70s or the beginning of the 2000s when stocks underperformed other assets. She also thinks the S&P 500 may fall in relation to gold and sees reasons why foreign equities will do better than U.S. stocks over the next 3 to 5 years. She does not, however, believe that the U.S. stock market would crash because, while running enormous deficits helps it to some degree, they also restrict how high equities can rise. For Bitcoin, she remains bullish. Despite its volatility, its returns have been so strong that its risk-adjusted performance is impressive across almost all time frames. She wouldn't recommend putting your entire portfolio into Bitcoin because of its extreme price swings. Her own approach, however, includes improving a traditional 60-40 portfolio by substituting gold for certain bonds and Bitcoin for some stocks. According to her, this results in a more robust portfolio that is appropriate for a time of fiscal domination. Don't forget to like, subscribe, and enable notifications for more valuable content, and as always, happy investing.